It is absolutely amazing the pickup in the channel lately. It's inspiring to me and it makes me want to do more. Smash the like button and subscribe to the channel. 8 things that did, among other things, I'm sure, but like 8 things that eluded me before I started trading. These things may elude you, but they may also be within you. If you have the right personality and you're balanced, you can hone those skills. You can just taper them and sculpt them into the ideal trader or investor for you. That smell. I love that smell in the morning. That smell of the ocean. It smells like victory. Today, it's the 8. It's the 8, the hateful 8. It's that pain that you hate, the hateful 8 things that I wish I knew before I got into trading or investing. It's constantly happening. The hype is constantly happening. Now you got cryptocurrencies and securities of those cryptocurrencies that people are trading on the markets. On top of that, blockchain, helped by the hype, okay? Number one thing I wish I knew before I started to get involved in the stock market, which when you get involved, you really get involved quickly. It's hype. By the time your neighbor knows about it and you're mowing the lawn and he tells you, he's like, hey dude, did you hear about this? GameStop, you know, whatever. That means that it's already gone bonkers. The whole idea is to be in there early, but you don't know that when you're first on the scene. So, do not follow the hype. I learned this. I had to go back 384 years to 1636. The first tulip bulbs came into Austria and eventually made their way to the Dutch humans. I mean, their economy, everything was flourishing. But by 1636, the Dutch guilder, florin, 100 guilder was 6,000 US dollars, to give you an idea, in 2020. So a tulip bulb, particularly the Viceroy at that time, was valued at between 3,000 to 4,200 guilder. 3,000 to 4,200 guilder is about 180,000 to 252,000 US dollars. Between 1636 winter to 1637 February, to be exact, there was a crash because nobody was showing up to trade. At that time, there were like 10 trades going a day, which is a big deal at that time. Tulip trades were going off. This was the biggest thing, the hypest. Its value went through the ceiling. And then all of a sudden, it crashed, it collapsed, it evaporated in February of 1637, never to recover. So that's what we call tulip mania, is what I'm talking about with hype stocks. I mean, that's an extreme example, but if there's something that you can't explain, you can't really read it, it's probably not what you should be investing in. It's something that I learned early on. Guys like Buffett, they're not into tech. They understand railroads, they understand wheat, Coca-Cola, things that are tangible in their minds, and therefore they can gauge how successful those things are. So at the start, stick with things that you understand. Now, I was really good at reading tech at the start because I was interested in that. Some of it doesn't even, the fundamentals don't even make sense, but when it comes to trading and the psychology and the sentiment behind tech, I could feel that. So that's number one. Don't follow the hype. Stick with that. 2, don't over contribute to your TFSA especially, or your cash accounts. Just watch how much you contribute. Pick an amount that you can sustain, that you are willing to possibly, in all possibility, lose and not ruin yourself financially. Just don't go overboard. It's very easy to get caught up and think, oh man, if I had 200,000, I could make 3, 4 quickly, and then things would just change. It would change my whole life. But these things happen over time, and before you know it, things grow, and then all of a sudden they start sprouting. If you diversify, they start sprouting. Don't over contribute. Just put in a certain amount of money and work with that. See if you can grow that. Test the waters, feel it out, take your time, and study these things. You're investing. You're not jumping on what your neighbor said is amazing. Put in what you can afford to lose. To be honest with you, I'm even talking about it because it's something that you get excited when you have a few gains. You're like, whoa, wait a minute, I could be making 10 times the amount. It takes time to do this if you want to do it properly. So I'm just laying it out there. That's number 2. Number 3, holding the bag. Nobody wants to hold a bag. When the stock is rising, by the time a lot of people get the confidence and get excited about some stock, it's usually done probably 60-70% of what it's going to do, maybe even more. Sometimes people just wait and they hit it, and then that's it, and it just drops right away, and it keeps dropping, comes to a reasonable level, because that's what the market deems the value of that security is at that point in time. Everything else was just a push, and then a lot of people sell at that point, it comes down. If you get caught in that situation, that labels you immediately a bag holder. Now you're holding the bag. Holding the bag is not a very fun thing to do. It's kind of embarrassing, maybe even in your own mind. Why do you want to have dead money sitting there? Now, if you ever get into that situation, and this is difficult in a TFSA, if you ever get into that, I personally have never had that issue. Thank God. I've never personally had that issue, but very important with the TFSA is try to get into stuff early and let it grow, okay? There you watch it because you could lose your contribution. But in all my other accounts, or any other accounts you deal with, if you get in a situation and a stock is dropping and you figure, oh man, I made the wrong move, right? There's nothing wrong with turning around and selling that for a slight loss, either just before the next year, before December 23rd of the current tax year, and then you could buy it back and claim it as a loss. Know that it's okay. If you really feel something's not going to recover or take a long time to recover, just take a hit, take the loss, get out of there quickly and put it into something that you know will grow quickly, or another security that you really believe in. Don't be worried about pulling out on a transaction. Don't get caught holding the bag. That's a rough one. Holding the bag is lame, dude. Yeah, it sucks. And it sucks. I had it happen to me, but never in a tax-free savings account, because then you have to totally wait out what's going on. Number 4, be very wary of media headlines and all the talk that goes on throughout the day. MSNBC, CNN, BNN, Bloomberg. I mean, I was on Bloomberg. Stephanie Rule, Deirdre Bolton. These women are great. Trish Reagan. I used to sit there with, and this is before we had real-time quotes. So I had a little Jimmy rig that I used to do is I used to add an extension to Firefox, and I would have like 30 stocks running on different screens. Really enjoyed Bloomberg because I enjoyed the environment, put me in the mode, gave me the terminologies. I learned a lot of the lingo. These are all things that I already had around me because I was on Wall Street and stuff like that and hanging out. But I never, you know, you hear all these things and it gets you into a mood. It gets your mind into that trading environment, into that environment where you're looking at world markets, getting up in the morning. But don't get engulfed by that stuff. These people are journalists and quite qualified. Actually, they're totally educated, right? But they're doing a job for the station, okay? And their whole thing is to keep the topics running. And a lot of those times, those topics wash in and wash right out. A couple of weeks, gone. We're not even talking about it anymore. So if you get all your ideas from people like that, having all these, speculating, they can speculate all they want, but you got to do your due diligence. All these analysts, it's all drama. And I'm telling you though, I made one move that was amazing, and it was Stephanie Rule. She mentioned in the maelstrom of the media, in all of this stuff, she said something that sparked my, and I think Trish Reagan was in on that, Steez, too, during like the Icon Herbalife thing. But anyways, they, every now and then they drop something, and if you catch it, it's brilliant. So there's nothing wrong with having that stuff on, BNN, Bloomberg, but it's not the word. Don't take that. That is drama, and it's made to move people through a trading day. It's like finding a needle in a haystack. You know what I'm saying? It sounds great, and they've got charts, and they've got video rolling, traders, the trading floor, the options floor, but in the end, it's entertainment, okay? So 98% of that stuff just looks like candy, but it's not gonna make you wealthy. Number 5, heed the projections of high-profile investors. I personally like high-profile investors. I enjoy them. They're entertaining. Again, they're entertaining. These guys come on shows and they have to say something. And it's great to put projections far out, right? Jim Chanos can short Tesla and Solar City and be on the losing side of that trade and still sustain it, survive that. A lot of guys have a few great deals, and then, you know, depending on the dollar values of those deals, they become something that is, oh man, well, he made this on this deal and this on this deal, so he must know how to predict the market, right? Nobody can predict the market. Nobody can do that. Do your research, do your due diligence. Just be wary of listening to other people when they're throwing out advice. And usually those guys are smarter than that. They're not throwing out advice. They're saying, I have a position here, I have a position. But they don't always win. They don't always win. They've had some big wins. Even guys like Chanos, they believe, and they can move the market in their own way. So these are all things that, as a retail investor, or someone that's progressed through that or gone through the pain of doing that, as such as I have, that is one of the things that I do slightly regret not knowing going in and being in my early days of trading. Number 6, invite market dips and crashes. Celebrate those times. Market dips and crashes are your friend. A lot of people get full on, they go all in, and then there's a dip. You gotta know what time of year it is. You gotta know what's going on in the world. When Vladimir Putin invaded Crimea, I got caught in a big investment, and it dipped like below half of what I saw my value decrease by 60% when that happened. And that was a world issue. That has nothing to do with the security that I bought, which is phenomenal. Actually, Microsoft bought it for $23 billion. So that was one that I was in, and I had thrown down a large sum of money for myself at that time because I'd watched it, and of all the things that happened, nothing happens with the stock, nothing happens with the company, everything is great with the company, everything. But guess what? A world issue, a possible war, fear becomes stoked and it gets smashed down, right? And I had to wait it out, and I prevailed in the end. But let me tell you something. In the end, buy fear and sell greed, right? Welcome a market dip. Welcome a slight crash. Know the reason for that crash and how it could recover. It's gorgeous out here. It's a little shady, but it's gorgeous. So yeah, welcome those things, right? Buy the fear, sell the greed. This is a common saying among traders, but I kind of wish I knew that at the start, because it's really frightening and painful to deal with that sort of thing. When the market dips, that is your opportunity. Guys like Buffett, all these guys stay cash heavy. They always keep a good portion in cash, ready for something like this to occur, right? Welcome the market dips, and buy that fear. When they stoke fear and they go on those bullboards, the media, everybody stokes fear, markets can drop substantially. And at those times, look at those good companies and those things you trust and start. There's a sale on at JCPenney. Get it on. There's a you ever see a shoe sale and women stampeding each other to get it? That's what I'm talking about. When that happens, it's time. I stay cash heavy for things like that, especially in the summer. Sell in May and go away. People, big institutional investors, go away in the summer. They don't have time for this. They go to Long Island. They want Fire Island. They're going to have a massive bender, or they're going to go spend time with their family. They don't want to think about trading. They've made all their money. They've done all their stuff. So be ready to follow the smart money when these things come around, because that is the bomb. So welcome those dips, and don't be afraid. Don't follow everyone else when they're afraid. Buy that fear. Buy that fear. Use it to your advantage. When people are fearful, be hungry. Get that security, and now you have the supply, okay? And when the demand presents itself, meaning when the hype comes back, when the neighbors are talking, when they're saying, hey, do you know about this? You're sitting there going, yeah, I heard. But guess what? You'll be selling, and they're going to be buying. When that demand comes, it's time, it's on, and you are now in control. Buy the fear, sell the greed, welcome the market dip, baby. Have a chase, because you might be chasing a case. Now that was directed towards another type of situation, a commodity at that. The first time I ever saw it was in the Mac. Number 7, again, the Mac. Going back to the Mac, talking about a different commodity, but this relates. Never chase stock, okay? You have a price in your mind, you know what it is. It starts to run away on you, let it go. Chances are it'll come back. And if it doesn't, let it go. There's always another bus. My man Jimmy, the killing of a Chinese bookie. That's another story altogether. Jimmy always said, bus a come, a bus a go. Always another bus. So never chase stock, guys. That's the thing. I got caught chasing it. It has to do with your confidence and your early trading and how fast these numbers are moving and what you're seeing. You're like, oh yeah, I like it, and then it jumps. You're like, oh yeah, oh man, I like it. I liked it at that price, but it's up like $3 more now. You're like, I like it, I want a piece of this company. You start to convince yourself that you need that, right? But in all reality, you're not part of this company. You like the idea, but you liked it at a certain price. Now it's almost like a quarter more than it was in the first place. Don't chase stock. It'll always come back, or there's always something else that's beautiful that you can get involved in, right? So don't chase. Okay, number 8, guys, bullboards. Now, if you don't know what a bullboard is, it is basically a stock forum. So people go on there and they talk. This is an AI personification in some form of people just shit-talking each other. Shit-talking stock, trying to drop it, trying to stoke fear in people. It's madness. Now, you can go on there and experiment a little bit. You may see some things that you like. There's a lot of good people on there, and the problem is a lot of the good people are people like yourself. A lot of retail investors and new investors are on bullboards and forums, okay? Choose those bullboards and forums wisely to begin with. Go to the more reputable ones where maybe you have to pay a few bucks for a membership, but there's some sort of regulation in it. Focus on your own intelligence, your own knowledge, your own research, okay? These guys are just sitting there saying, you know, trying to destroy companies. They're shorting the stock and they're trying to drop it, and then they're trying to raise that again, okay? Which is quite disappointing, actually. But that is the nasty game of bullboards. Don't get caught in that. It's just a dramatic mess. Stay away from bullboards, because bullboards are just a bunch of people that have their own agendas. There's unfortunately, people get caught up in the mix there, right? They get frightened. They're trying to frighten people out of selling their stock and getting that stock cheap. I'll be honest with you, no matter how smart you are or how sharp you are, when you get into that world, you get I got a little bit drawn in for a short period of time. Stock twits is fine, right? But you have to take that in context and know who's saying what. Some of these people even work for small, greasy firms that basically do that. When the fundamentals are there, in all reality, it'll go back up, but there may be a lull in the stock. And at those weak points, without any news, right? If the company's in between and they haven't released news yet or anything, these guys know that stuff, man. They totally know what's going on, and they will stoke fear in the news, on the internet, every which way they can. That's what they do. They stoke fear, they freak people out. Just stay away from it. Smash that like button, hit subscribe. Yes! Protect yourself. I'll see you next time on Gold Finance. Yes. Tony Gold. Ow. These people go? Yes. With their lovely dogs. You always respect the humans because they don't have airbags.